How are we doing here? Yeah, I think pretty good, right? Yeah. My director, producer.
Slash wife.
We got 3 people.
There we go. I think we're good. That's good.
Mama.
Hi, Zeke. How are we doing? Zeke, you want to say hi to the people? Come here real quick. I need your help. I need you to click this button for me. Can you come over here and click this button for me? Come here. Come on over here. See, there's a little... Go click my button. Hit it. Hit it. Shy boy just woke up from his nap. Happy Friday, everybody. Oh, I'm going to have to get some sort of a happy hour thing. I think we've got beers. Just grab a beer.
Can I click the button?
Yes, go ahead. Press the first button. This is Athena Rose Thomas. Go ahead, click the button. Oh my gosh, you did it so well. Aren't you glad it's Friday?
Yeah.
Yes, me too.
I'm getting
glad
my
it's
hair
Friday.
cut today.
You're getting your hair cut today?
Yeah.
What are we getting?
Pixie.
A pixie? Oh my gosh. I got it. Here I am. Don't even have the microphone. You're getting a pixie, huh?
Yeah.
Fantastic.
Brennan and Michaela.
Yeah.
Are they? Brennan and... Hey, Brennan. Brennan's in Washington State. Guess what? I hear they're getting 5 to 7 inches of snow right now.
And Michaela's there too.
That's funny. Michaela, how are you doing? She's busy planning for a wedding. And look, she has enough time to check us out here. Zeke, you want to say hi to Brennan?
And Michaela.
And Michaela? Come on over. Yeah, no, Brennan and Michaela.
Here, I'll say.
Shy little boy.
Hi.
Anyway, let's go ahead. So, there we go. I want some pictures, Brennan. I want some pictures of all that snow. It's always fun, the first snow. And then the second snow is pretty fun. But then by the time you get to the 20th snow, that's where it's not as fun anymore. But this is their first snow. It's always good. And his girlfriend likes to ski, and he's going to teach Brennan how to ski. Pretty cool, huh? Anyway, I'm a quantitative economics decision sciences major from UC San Diego, 29 years in the business, Orange County native, Capitol Valley High School grad. And hey, Logan's on. Bubble Boys. Wow, yes. Happy Friday to everyone, even the housing bubble boys who blew it in 2020. Well, Capitol Valley High School grad, 9 kids, avid runner. I brought 6, my wife brought 2. We had bonus guy Zeke, and that's the story. I've also been in the press, and our company is Reports on Housing. It's your local real estate snapshot, and it's all about driving home what's going on in the marketplace. I don't really focus that much on closed sales data, although it kind of shows us where we were, but as far as planning is concerned, where are we going from here? I like to look at the active inventory and the pending sales, the last 30 days worth of pending sales. That's what I refer to as demand. So that's the supply and demand, which gives me how fast we're going down the road, and that's expected market time. Agents like to utilize days on market. It's not that great of a stat. Instead, I like to use expected market time, and it really gives me the speed. The lower the expected market time, placing your home on the market, when you're opening up escrow, the faster the market is. So, like right now in San Diego, they have a 33-day expected market time. That's like traveling up the I-5 freeway at like 150 miles per hour. LA is like 44-day expected market time, a little bit slower than San Diego. So anyway, it's all about setting expectations. We have a lot of reports that dot all over Southern California, Orange County, Los Angeles, San Diego, Riverside, and San Bernardino. And the most recent one that came out, gosh, I put the wrong one on here. It's Powerful, Strong, Resilient was the prior one. The one that just came out is a report that we did and focusing on where we are going for the remainder of this year in as far as price appreciation is concerned, and where we're going to go in 2021. So it talks about going up, because that is exactly what's going to happen. We're going to get some price appreciation. We'll get a copy of that when we do this report next week. Anyways, our company is Reports on Housing. That's our website. Go navigate to that, hit the subscribe button, and it comes out every 2 weeks. And it's $15 per month or $150 per year. You sign up today or over the weekend, and we'll send you the most recent report, which is values going up. So that it's $15 per month or $150 per year. You get a month free if you sign up using the coupon code of October. And I'd like to thank our sponsor. Look who's back. It's my buddy and your buddy. It's Kevin Buddy from Monarch Coast Financial. And Kevin Buddy and Monarch Coast Financial, like everybody else, they deal with more than one kind of borrower, right? But they also have more than one kind of loan, and it's from everything, full documentation loans to alternative documentation loans, investor financing, and private money loans. So it's everything from full doc to private money and everything in between. And he has loads of experience. I mean, he's been doing this for a super long time and helping buyers achieve their financing their dream homes. And he's been doing it since 1976. So he's been doing this for a very, very long time, since he was 10. But anyway, Kevin Buddy, you can contact him today, and he can help you as well at Monarch Coast Financial, and you can reach him at 949-422-2075. That's 949-422-2075. So here's some fun photos that I wanted to get to really quick, some fall fun photos. And this is one of my kids' favorite part. Actually, none of my kids are in front of me right now because they're busy relaxing after a long week of school. So this is me calculating how much sleep I'll get if I watch one more episode. And this is quite literally what my wife and I have done, because we were binge watching a couple of series on Disney Plus, and we finished those series, by the way, so now we're looking for new series. But how about this one? I can't believe we used to eat ice cream out of a toilet paper roll. This is true. I never even thought of it. Yes, that is a toilet paper roll, isn't it? Anyways, cable repairman was on the street and asked me what time it was, and I told him between 8 a.m. and 1 p.m. Oh, how about this one? 2020, it was the scariest thing I could think of. There's their Halloween display. 2020. I'm this old. I want my kids to verify that they have no idea what this thing is. Scantron. Anyways, how about this? The Southern California housing market, where we are today, quite literally, we are speeding. We are speeding in all of Southern California. And the hottest markets are San Bernardino, San Diego, then Riverside, Orange County, and last is Los Angeles, in that order. And we typically have various seasons: spring, summer, autumn, and winter. We're at the tail end of autumn typically, and then we hit the holiday market next month once we hit the week before Thanksgiving. However, we're not really following any season. We're following the season of 2020, and the Southern California housing supply wanted to get into it. It looks like it's totally been flatlining for a very, very long time. Typically, we go up and then we come down. So we went up, we peaked, and then we were kind of have been flat. And this is where we were a week ago on Thursday. And where was that? October 15th, 26,002. That was up 2% in 2 weeks. And then last year we were at 41,690. That was 60% more than where we are today. And that's the story. More, we are at a very, very small level of inventory. There's more every other year since I've been looking at this in 2004 in Orange County, and or actually 2009. And back to 2012 for all the other counties, because I just started crunching the numbers for all the other counties in 2012. So last year was 60% more. Today we crunched the numbers and we're at 25,793. So we are finally going down a little bit. So we'll see if that continues. It really should start soon, because we're getting towards further into the school into the year, and we're running out of months before we get to the holiday market. This is not actually typically the best time of the year to place your home on the market, but we do have the pent-up demand that will continue to gobble up homes that come on the market all the way through the end of the year. It's the lowest October, like I said, since I tracked for Southern California going back to 2012. As far as Southern California housing demand is concerned, this is the opposite. This is the opposite story. We've had very, very low inventory. Now we have very, very high demand. So low inventory, high demand. Remember, I talked about Cabbage Patch dolls last week. Well, This is where Southern California demand was as of last Thursday, a week ago yesterday, October 15th, 20,447 new pending sales over the last 30-day period, and that was up 0.5% in 2 weeks. So it actually was increasing a little bit. And last year we were at 15,650. That was 23% less than where we are as of last Thursday. So year over year. Today we're at 20,491. So basically the same. We're continuing to go up a little bit, 0.4%. And this is what I refer to as Oktoberfest. It's when we get a little extra helping of demand in the month of October, because a lot of buyers, family buyers, can close. They like to close in the spring and summer. They also like to close in the month of December when the kids are out on break. And that's because it's in between semesters. If you need to change schools, you can. It's between one semester and the other, and it's a much easier transition for children. So, and also you can do a local move, and it's not that disruptive as well. It's the strongest October as far as demand is concerned, period, since 2012. So you hear that, the strongest October in demand and the lowest level of inventory in October since 2012. So both those metrics are going at the same time, which means what is the speed of the market, the whole velocity, how fast are we going? We are moving extremely fast. And this just shows you right here where we're at. If I draw my big yellow arrow right there, it's October 15th. It's at 30-day expected market time for all of Southern California. Anything in the 30s is absolutely ridiculous. There are some cities that get down into the teens, or in the 20s, it's extremely hot and they get down into the teens, and that is like what you refer to as instantaneous offers. And yet, even in those ranges, there are still a portion that have been on the market for 60 days plus because they don't know how to price their homes. SoCal last year was at 80-day expected market time, and this is the difference between this year and last year, and big difference. Today we're at 38 days. When I do the math, it's nearly the same, so it's not that much of a change, but it actually was down a little bit, but decimal points down, so I don't like to show you those decimal points. Doesn't make that much sense. So as far as expected market time and where we're at, this is the speed. The lower the level, the hotter the market. And you can see when I draw a line across, it even beats 2013. And we are in the month of October. This happened for September and October. I put August and September. I have not done that, fixed that slide from last week. It's the strongest demand for October and the lowest supply of active listings for October. We have low supply, a lot of demand, juice demand. That is the recipe for home values rising at a very fast pace when I see the expected market time as low as it is in Southern California. And what's driving it? Interest rates. And where are we at with interest rates? Check this out. We hit 2.8%. If you remember last week, we hit a new record at 2.81%, and now we hit another record this week. This is Freddie Mac's 49-year-old mortgage market survey, and it's the 11th record low this year. Seriously, that is unreal, unbelievable. And now let's talk about all these buyers that are wondering, you know what? I'm going to wait. I'm going to wait for a buyer's market. And the reason why I thought about this is because I had an agent actually ask me, they told me about a client they have that wants to wait for the next buyer's market. I'm sitting there thinking, so when would that next buyer's market be? So I understand if you're a buyer, it's extremely frustrating. So you're looking at alternatives. You hate to compete with everybody else, but you're competing with everybody else because of where interest rates are currently at. And if you look at it, I understand you're waiting. You're going, man, I wish it was a buyer's market. I wish it would slow down. But we're going to talk about what it's going to take to really slow down a market. So a lot of these buyers are sitting there just waiting. They're waiting, and they think, I'm going to time this market down the road. And I really would prefer it being a buyer's market. I mean, it eventually has to turn, right? So here's what we're going to take a look at, though. We got to look at supply and demand again. We got to look at the supply and where we're at, which is, what did I say? It's like the lowest level for October since 2012. And I will say that it's an extremely low level period anyways. We're going to start off the year with a record low level of homes period since I've been dealing with this in 2012. So you can see, if we're at a record low level for October, where are we going for the remainder of the year? I mean, we're going to flatline a little bit and then come down, and we're going to start off with very, very few homes to start off the year of 2021. So, and then we have demand. What's going on with demand? We have just juice demand. This is the last 30 days worth of pending sales total for all of Southern California, and you can see, look where we are compared to prior years. It's at record levels as well. So we have record low levels of inventory, record high levels of demand. That means housing right now is extremely strong, and it's not like what we were dealing with prior to the Great Recession. So that one you could actually see coming, especially when you look at all the stats and data. You could actually see that coming starting in the fall of 2005. And you could see it in the inventory. The inventory rose to a level where it slowed things down, and we were at a very, very high level of homes on the market for all of 2006 and all the way up to when things started to crumple in March of 2007. So you need for the market to really cool down, and you need for demand to absolutely go away. You need just a few people looking at homes, not a ton of people like we have today. So for that to happen, that typically the transition from one market to the other takes at least a year in order to totally move from one market to another market. It does not happen instantaneous. I mean, it felt like it was going to when we were going into this pandemic, and I had a lot of people panicking, saying within the next 90 days we'll see values go down 10%, but that just did not hold true. Some people are holding out for 2021, hearing about these waves of foreclosures that are coming. And I told you, there's not going to be a wave of foreclosures. There will be more foreclosures, but it's going to pale compared to the Great Recession. So there will be a few. It's not that big of it. It's just not going to happen in 2021. And I've talked about it in many of my housing debriefs prior, that we're just not going to see that wave of foreclosures. We're just not going to see the market transition to a buyer's market. We're starting off the year with record low inventory, with interest rates that are really low. So we'll have juice demand at the beginning of the year. And we do most of our movement within that first half of the year. That's where we have a lot of activity, and that's where it's going to be prime and ready to go because of where rates are at. And so this is the expected market time where I'm showing you an example of where we started off here and we went all the way up here, and this was 2018 as we got interest rates that were going higher and higher and higher until we got to all the way up to 5% interest rates in November of 2018. And I remember sitting on a panel with Logan, and at that time Logan was saying, rates are going to be going down. And he explained why and everything else, and that's when I became a firm believer in everything that Logan Mohtashami had to say. So pretty awesome, and he's on his feed right now, and he's posting. So follow him. He has a lot of great articles and everything else to talk about the housing market and the overall economy. But as you can see, it takes a year in order to make that kind of a transition. And right here below this line is a hot seller's market. That's actually where we're at right now. Then between here is what this is 60 and 90 days expected market time. And that is where we behaved almost all last year. This was last year. We came down and then we behaved here. That's a slight seller's market. That's where sellers get to call more of the shots, but we don't have values going up that fast. That was the story of 2019. Once you get above 90 days and in between 90 and 120, that's actually called a balanced market where it doesn't favor buyers or sellers. We were there for a minute during the pandession at the beginning of the what I call the recession, the pandemic recession, the pandession, the beginning of it. And this was this was April, and then we came down starting in May. And but we were up there only for a short period of time, came back down, and now we've been playing in this hot seller's market zone. So this is balanced. This is where it doesn't favor buyers or sellers. Nothing's happening as far as values are concerned. Then you got this next one. So you start a buyer's market at 120 days, but it's a slight buyer's market. It's not a deep buyer's market until we get above 150. And the further you get above 150-day expected market time, the further you get above that, the more that we start to strip away value. And that's what a lot of buyers are waiting for. There's more inventory in here, but there's not a lot going on in value. A slight buyer's market is where buyers get to call more of the shots, but we're not really seeing that much of a change in value. And you only get it when you're above this 150 threshold, and you have to go even higher. When we hit the Great Recession, we were hitting an expected market time above 400 days. And when you have an expected market time above 400 days for everything, that's where we started to get wholesale of property. And we had this deep movement in values. And that would take being way up here, and you need a lot of homes on the market, and you need demand to be at just this inertia demand, this demand at the very bottom, and which is what I call inherent demand. And we're not going to get there anytime soon. You mean, what would it take? We're an interest rate driven commodity, housing, and when interest rates start to climb, that's where we start to see some people peel off and fewer buyers in the marketplace. But we need interest rates to go up quite a bit. So, but the problem is we have interest rates. Remember, we have these record low interest rates. I talked about it. We've had 11 record lows this year, starting in since we've been in the pandemic. So, but where has the interest rates gone since the 80s? There's this big pressure of it coming down. There was just a hot minute right here where it was above, where it was just hitting about 5%, and then it came down ever since then. And you need a lot of great economic news in order to drive these interest rates up higher to above 4%. And even up above 5%. That's not going to happen in 2021, because if you've been following what's going on with vaccine, we're not going to totally deploy the vaccine where we start to see better travel, we start to see the airports humming, hotels humming, amusement parks going, stadiums filled with people, restaurants full, there's everybody going back to Disneyland, everybody Knott's Berry Farm, Magic Mountain. That's just not going to happen for quite some time into 2021. So with that not happening for quite some time, they're not even talking about opening up Disneyland for like another year. So that's a long time to wait for everything to totally become unlocked, and then we'll start to see interest rates probably rise as the economy totally improves. But we're talking interest rates rising to what? 3.5%, 3.75%, maybe 4%. That's not enough to turn this thing into a buyer's market where there's so many homes on the market and it brings demand down to nothing. That's just not where we're at, and there's pressure for these rates to remain low, and they're within levels. You can talk to Logan; he'll talk about the different levels where the 10-year needs where it operates, and that's what kind of dictates where interest rates are headed. So. And I wanted to give this example before I wrap it up on waiting for a buyer's market and why it just does not make sense. And this is this chart that I've been doing for a while. It's if you're designing a $3,000 per month mortgage payment with 20% down, at 5% you're looking at just shy of a $700,000 home. At 2.8%, you're looking at a $912,500 home. Do you see the difference? You're looking at over a $200,000 difference, and yet the payment is still the same. And I'll bring this down to the bare brass tacks to let you know that at $912,500, that's what that example was. You're looking at a down payment of $182,500, a loan of $730,000, and your payment is $3,000 per month. That's principal and interest. We're not doing taxes, association, all that stuff, because of course taxes would be up a little bit, and so would insurance. But I'm just doing principal and interest as an example, just to show you how far your money goes. Now, with interest rates at 4%, so we went from 2.8% to 4%, now you're looking at a $785,000 house. $157,000 down, the loan is now $628,000, so a smaller loan amount, yet you have a higher rate, still $3,000 per month. That is 14% less of a home compared to what you're able to get today at 2.8%. And how about this? So at $690,000, it's just shy of $700,000. The down payment is of course smaller. Your loan amount is only $559,000, but your payment at 5% is $3,000 per month. And now you're looking at 24% less of a home. So, and there is nothing in the cards that would strip away value all the way down to 24%. Remember, everybody likes to compare this the housing market and remembers that big recession where values came down. Now that was the Great Recession. The Great Recession was caused by real estate. It was bad lending practices, subprime pick a payment plans, all the junk that was there. Wall Street gobbled it up, and they gobbled up bad loans, and there was tranches of loans that investors would purchase, and they had bad paper in there, and they were labeled A paper. Remember that? That's the movie The Big Short goes over that whole entire thing. Well, we don't have anything like that. Flash forward to today, and we have a housing stock that's very healthy. We're not using our houses as piggy banks, and the overall housing stock looks really strong with a lot of equity, and not as and as the amount that we're leveraged our houses is not that big compared to the amount of equity that we have. So there's a great chart that shows 2006 versus 2000. I should have put it in here. 2006 versus 2020, the second quarter, and it shows how much more equity there is in a home, in the housing stock, versus the tiny rise in the overall amount that's financed of the housing stocks, which means that we're in a very, very awesome spot. So here's what I have to say to buyers that want to wait for a buyer's market. Do not wait for a buyer's market, period. Please don't. So that's my conclusion. Well, now we're going to go into the coronavirus really quick, because what happens with COVID is what happens with the economy. This is worldwide. You can see what's going on right here. This has not been a good last couple weeks as far as the world's concerned. 42 million cases now around the world, and we're at 397,000 new cases every single day for the last 7 days. That's the average. That's what this is, 397, and this average keeps on going up because when you look at the daily numbers, it's actually been rising on a daily basis. We're going into that second wave in the world right now. Europe is hitting it, and so are we. I told you last week, Europe hit it because they relaxed their travel restrictions. Only 17% of Europe even had travel restrictions, and what happens when that happens? Well, they ended up reinfecting. They had their first wave, and their second wave is way worse than their first wave. And they're having major problems in France, Germany, France, Spain, and UK is by far the worst, but all Euro countries are having a problem. Even Germany and Italy is having a problem at this point. So it's not looking good over there in Europe. They're at 4.7 million cases and growing pretty fast. 119,000 is the 7-day moving average. So for the last 7 days, they've averaged every single day 119,000 new cases per day. 119,000 cases. That's like off the charts. If you look at the United States, this is where the United States is, and the European Union is way higher than us. But I like to do this normalized by population because Europe has 446 million inhabitants, citizens, and we have 328 million. So when you do the math and you put this together, you could see we're on this trajectory where we're going up. I think we're going to do something like this, but I think we're going to continue to rise because just yesterday we hit a number that we have not seen since the end of July. We were in the 70s, and it doesn't look like it looks like today's not going to be a very good day for COVID either. If you look at this, there's 8 million cases across the United States, and that was last week, and it went to 8.5 million as of this week. And last week we were at 53,500 cases, and that was on a 7-day moving average. Now we're at 61,000 for the last 7 days. So you can see the direction that it's headed is up because yesterday we hit it in the 70s. So what does that mean? It's going to bring up the average as we go forward because we hit a gnarly day yesterday and probably another bad day today. And the increasing COVID-19 hospitalizations across the United States, pick this off of ABC News just because I like these different charts that just show that where they're having a problem with increased hospitalizations. It's a big chunk of the country has seen an increase in hospitalizations, and that's another way of tracking how COVID-19 is affecting the United States, and it's through the number of hospitalizations. And as far as COVID-19 testing is concerned, this has been going the wrong direction. We are finally getting down towards 5%, and then we did an about face, and because we're entering the second wave, this positivity rate has been increasing, which means that as we there are certain areas like Wisconsin where my brother and sister are. It's almost out of 1 out of every 4 people that they're testing is testing positive, which means there's even more spread, but they can't even test everybody out there. And they're only testing a few people that they think might have it. Not everybody's getting tested. So 6.9% positivity rate is going the wrong direction. We need to be below 5, well below 5. They're saying about 3% in order to do contact tracing. In California, we actually done a pretty good job of contact tracing and all that stuff because we have a positivity rate that's pretty low for the United States, because we do a lot of testing. California is at 868,000, and the average is 6,400 for the last week. There's been a problem. We're starting to go up. So we were dancing along this line for a while, and then we just hit a higher amount yesterday. So we'll have to see exactly what that does in the long term. But let's see. As far as opening up the economy is concerned, let's check this out. This is the state metric system, and this is the different tiers. So this was last week, and this is this week. There wasn't a lot of changes, but check out what happened in Riverside. Yeah, they went purple. And this is where everything is currently at in Southern California. Only Orange County and San Diego County is in the red. Nobody qualifies to go down right now based upon the metrics that we had last Tuesday, this week. And you have to have good metrics for 2 weeks solid in order to go down to the next tier. Well, there is Riverside went the wrong way. They actually 3 weeks at the purple. They argued about it for an extra week, but they still had a third week, and then they went to this purple tier. San Diego, they're dancing right around the 7 number. They need to be below 7 in order for it to continue to stay in red. So if they remain at this purple level next Tuesday, they'll probably argue about it for another week, and then they have to have 3 weeks of it, because that's kind of what happened in Riverside. That's probably what would happen in San Diego, because they're dancing right along the lines. But this is not the right direction for San Diego either. And then we have the macroeconomic outlook, and we'll get to the Q&A that you guys can dial up. But the initial claims for unemployment insurance went down from last week, but we're kind of stuck. We're stuck here. These initial unemployment claims are continuing to be so high because we have different pockets across the United States where when they shut down certain areas, or they say no, they shut down bars, and people become unemployed. So this initial unemployment claim keeps on staying at a pretty high elevated level, and it's at this 787,000 right now. That's the initial unemployment claim as of this week, the number that were released. And remember, for in the Great Recession, the peak was 665,000. We did it over a longer period of time. It's just something to take a look at. As far as the continuing claims for unemployment insurance, this is being on the unemployment doles for if you're on it for 2 weeks, you're counted in this metric, and it actually went from 10 million down to 8.4 million. So this number has spiked like crazy and has been coming down on a weekly basis. So this is going the right direction, but you can see it's still a lot higher than where we were at the Great Recession. These levels that we're at currently. And this is rent payment tracker. This is on a week. They check this. They check this as a national housing apartment metric that they check. There's between a little over 11 million apartments that they look at, and the people that are paying on time. Well, this number is through the orange is through the 6th, and then this pink is through the 13th, and they just released the blue that's through the 20th. They do that 4 times during the month to see where the rent collection is at. Well, right now it's at 90.68% through the 20th. That's better than where we were at last month, and even in August. You have to go all the way back to July for it to even be better. It's still off from where it was last year at 92.4% at this time. So, but we'll see where we're at by the end of the month. I'm actually pleased that it's not as bad or not as big of a hole as what it could have been had people not saved their money and are being a lot more mindful as far as their family budgets are concerned, it seems. And forbearance, where's forbearance at? It dropped from 6.32% to 5.92%. and now it's at 3.1 million. It was at 4.3 million in June. So you can see we've come down quite a bit, 1.2 million. And all the studies that have been done, these people that have come out of forbearance are actually, they negotiated everything out and they're paying their mortgage on time, the vast majority of them. So that's a really good sign of this forbearance program and how it is working. But you need to know there's still another additional million people that are not in forbearance that are behind on their mortgage. I've shown you why this is not going to be waived, because 90% of everybody in forbearance has at least 10% equity. And with that said, that leaves exposed 10% of 3.1 million is about 310,000. So you can see while 310,000 is a lot, they're all not going to be foreclosed. Some of them are going to get their jobs back, and now you're looking at about maybe half that, 150,000 people that may be a short sale or a foreclosure down the road because they don't have enough equity in their homes. But that's not a wave. That's nothing compared to what we were dealing with in the Great Recession. So you can breathe this sigh of relief that we're not going to see a wave of foreclosures. As far as purchase application index, this is done by the Mortgage Bankers Association, and it's up 26% year over year. It's coming down from the volume, but we're looking at, it always does in the during the autumn months, and then it does during the holidays as well. But still, we can look at year over year statistics, and it's up 26%, which it's been 22 weeks now of year over year positive growth. So that's pretty fantastic as far as this chart is concerned. It says that we have a lot of demand moving forward, a lot of people that still want to purchase homes, and here we are getting towards the end of October. And as far as existing home sales are concerned, this is the seasonally adjusted annual rate through NAR. Did you see this that came out? It is up 21% year over year. And we have to understand part of this is because we bumped our market all the way till now, but the metrics across the United States, you have to understand we're dealing with a low inventory, and the reason we have a low inventory is because we have everything in escrow, and so we have a very, very high escrow rate with interest rates being so low. So we're poised right now to continue to have a really hot market throughout the end of the year and into 2021. So go to reportsonhousing.com, REPORTS, reportsonhousing.com, click on subscribe, and you get a month free if you use the coupon code of October. And thank you again, Kevin Buddy from Monarch Coast Financial, for sponsoring us. And he in Monarch Coast Financial does more than one kind of, they have more than one kind of borrowers, so they do more than one kind of loan, and everything from full doc loans to private money loans and everything in between. So they deal with it all, and he has tons and tons and loads of experience, and he's been doing this since 1976. So you know what? Contact Kevin Buddy at Monarch Coast Financial and let him help you. 949-422-2075. That's 949-422-2075. And now it's time for the happy hour Q&A. So, I wish you guys could see my outfit. I look very professional from the waist up, and did a workout with my wife earlier today. So I have my workout shorts on, and I have my workout shoes, and I'm wearing shorts. But I look professional from the neck up. That's all that matters, right? How about the other day? I went to Starbucks with my wife, and I got out of the car to go pick it up with my mask on because we order ahead with mobile. And I went out of the car, and then I came back and I said, "Do you know what I realized? I was wearing shorts, and I had a white button-down shirt." So we're all getting used to it, right? And I didn't see too many people laughing like crazy. So you might ask what I am having right now. I'm having an Alaskan Amber. Yes. That's right, an Alaskan Amber. So cheers to everybody. Do we have any questions yet? My love. Anybody have a question? I'll be more than happy to answer any question that you may have. I hope you don't report flu cases during flu season. That's hilarious. If
it affects housing, no?
If it affects housing, I will. If it affects the economy, I will as well, because that affects housing as well. So, yes, that's what we will do. Wow, so we have Any questions? Anybody? I'm going to drink my beer while I wait for somebody. That's right. So far, no questions. So I'm going to say, wow, that's a really good beer. I really like myself a good amber. This is my best fourth quarter of my career. I think it's going to be the best fourth quarter of a lot of people's careers because of how busy it is. And this is where it's going to slide. So all those people that are expecting to totally enjoy their Christmas and holidays, I'm so sorry. Hanukkah, all of it's canceled for you because you're going to be so busy. It's going to be hard. It's just going to fly by, kind of like this year has. The first graph showing, I'll send that to you later, Bob. The first graph showing today's pricing. I missed it. Let's see. Is there a reason to anticipate a recession is already happening? I don't see it. No, we had a recession. We had a recession, and the second quarter and third quarter were recessionary. So, but this third quarter, the first quarter and second quarter were recessionary. The third quarter was will be positive compared to the second quarter. So we will be out of our recession as of the third quarter of this year. So what effect, if any, has California AB 3033 having on rents my landlord cannot collect until next year? Yeah, that's awful. So I know there are some people that are having a problem collecting rents. My thing is I would work with my attorney and find out what all my rights are first. And second, I would be negotiating with my tenant to make sure that I get them on some sort of a payment plan where they're paying something. So if they're even getting, if they're unemployed and they have unemployment checks, just to work out to get them in the habit of doing something until they get to the other side of this, I think is going to be pretty important.
But you would check with your lawyer.
Yeah, well, I would be checking with my lawyer, but I would be negotiating with my tenant to do something. I know that the way that it works through Sacramento is by the time you get to January 31st, they have to pay 25% of all of their rent from August through January, I believe. And the 25%, if they don't pay that, come February 1st, evictions can start. So there's a moratorium until February 1st. So there's an agent in San Diego organizing webinars stating that fact. Stating what fact?
Anticipating recession is already happening.
Oh, yeah, isn't that weird that some people think that there's a recession that's already going on? It's definitely not happening in housing, and you look at enough of the numbers, and I think Logan referred to it as best. There are people that are bears. They're perma bears is what he likes to refer to it as, where they're always looking for the negative in the overall economy. And I watched, just for the fun of it, about once a week, I watch one of these where they talk about housing crashes and recessions and housing and all that. I want to see where they're coming from. And there's not really any sound evidence that anybody's provided. There's not the data. I've heard this one, they threw up like 3 charts and it really had nothing, they didn't really connect the dots. And other than that, he talked for 30 minutes about how it was going to go upside down. Love your information. Thanks, is always great. I heard we will have a vaccine in 2 weeks. I don't talk about vaccines and all that. I will say this. So as far as the economy is concerned, we need to see this vaccine and when it's totally deployed. And I've looked at all the experts and all that stuff, what they think the vaccine timeline looks like as far as it being deployed to everybody in the United States. And the timeframes are all over the place. So if all the experts have timeframes all over the place, it means they have no idea how it's all going to work out. So it's almost one of those things where we just don't quite know when we're going to be to the other side of this rainbow. So I think the best thing to do is anticipate that at least we're not going to get inoculated until the middle of next year, which will keep interest rates really low, which will create a lot of demand in real estate for our spring market come 2021. Yeah. Let's see. Working with my buyer, I just got accepted. Yahoo.
So what is the formula for average day on market?
What is the formula for average days on market? I don't do days on market. I do expected market time. The formula has to do with how much inventory you have and how fierce demand is. So the last 30 days worth of pending sales. So based upon the last 30 days worth of pending sales, I can see how long it's going to take to eat up the current inventory that we have. So when all of a sudden we get a whole bunch more homes on the market, yet demand remains the same, and we get an elevated number of homes coming on the market, we'll see the inventory continue to grow and we'll see the market slow. So that's actually what happened when I originally did the housing report in 2004. We all of a sudden got a ton of homes come on the market. The average days on market was really low. It was like 14 days for all of Orange County back in the day, because so many homes were coming on at such a fast pace. Yet it was super slow out there. You couldn't sell your homes. That's because we had a very, very low demand at that time. This was June of 2004, and we had a lot of homes. So days on market was an artificial reading. Instead, you take the total amount of homes on the market, that's the inventory, and then you take the demand, that's the amount of activity, people gobbling up the inventory. So based upon how much demand you're getting, if you have more demand, you're going to eat up the inventory faster, and then we have a faster market time. That's the expected market time. If you have a big amount of inventory yet small amount of demand, you're not going to be eating up the inventory fast enough, so it's a slower market time. Where we are at right now is very few homes on the market at this pool and a very voracious appetite demand, and there just are not enough homes on the market to satiate the appetite of where demand's at right now. So we're speeding. Where the expected market time is extremely low. That's where we drill down into the 30s. Cheers, Alana, Joe, Micah. Do we have another question? Market will change in 2022 then? I only like to do 1 year at a time. Once you get beyond 1 year, there's so many variables and so much uncertainty that you don't quite know where it's going to be. This is the thing that people like to say. So what we might get interest rates that float up a little bit higher because the economy does better down the road. Who knows when that will be? We get 4.25% interest rates, or maybe 4.5% interest rates. That will slow things down. It won't slow it down to the point where it'll tip it into a buyer's market, but yet it will feel a lot more sluggish. And that's where we were back in 2014, and it was where we got to 2018 because we got interest rates all the way up to 5%. But it wasn't enough where we saw values dropping. If we would have sustained that level at 5% for quite some time, yes, at that point we could have done it, but we didn't do it. But
Someone says they can't hear you.
somebody says they can't hear me, huh? Let's see. So I don't anticipate the market changing in 2022, but I don't like to forecast. I don't like to forecast that. So the pressure for rate increases would come from the inflation, and yeah, I don't see. Inflation is not one of those things where you can talk to Logan more about that, but we're not super worried about inflation. The big thing that everybody says is when we spend a lot of money that we get inflation. Well, we've been operating at a deficit for a very, very long time, for a super long time. I think the last time the budget was even balanced was Clinton, back in the mid-90s. Since then, we've been operating on this deficit that it really hasn't changed anything. So we haven't seen inflation go out of control. So I really don't anticipate that being what drives interest rates up. We will just have to wait and see and look a little bit harder. But you can watch Logan. Logan will talk about that. Have the CAR revised their price decline call from earlier? I thought it was. Hey Logan, I thought it was interesting to see CAR project a increase appreciation of 1.3% for the year. I think we might do that in the month of March alone. That's how busy I anticipate our beginning of the year to be. So let's see. There's an agent on Facebook here in San Diego organizing webinars stating the fact that a recession has started. I would love to, please, if you can get me that, I'd like to look at to see what he has to say about it. But I can tell you this: we're hitting a record number of homes in the luxury price range that are closing right now and that are in escrow right now. The expected market time for all of San Diego is like 33 days. That is one of the hottest markets in all of Southern California. So I just would love to see the data that backs that up.
Do you have any suggestions about the best way to prospect during COVID?
Yeah, prospecting during COVID. It's just be be the person in your area that knows the most about the area, data, stats, what's going on with the local restaurants, and get to know the owners and all that stuff. That at the end of the day, you can let everybody know. You are then the mayor of the area as far as knowing everything going on with locally, economically, as well as what's locally going on housing. Having all the data, stats, and all the local information is power, and people are going to want to tap into that person. So a lot of this can be done electronically, and Facebook, creating Facebook pages for certain areas, things like that. I mean, that's what I would do. I think electronically is a great way to go. It's also getting the word out to all of your sphere of influence and past clients and letting them know exactly what's going on in the marketplace. And it's so hot that and rates are so low that they should look at either refinancing or maybe making a move up. And there's not a lot of homes on the other side for them to purchase, so you can always list your home and sell it contingent on you finding a home within like 30 days. That is definitely something that can be done. So you have a buyer that's on the hook, but now you can go look and find something within 30 days to pull the trigger on so that you can make a move. So that's what I would suggest doing. Excellent job. Do you have any stats on companies moving out of California or just individuals moving out of the state? Disney layoffs? Yeah, I've read about all that stuff, and I've been keeping up with that. The Orange County Register has been really good at providing a lot of that information locally here in Orange County. But I'm looking at all the layoffs and the overall economic impact. And where the sectors are that are most affected. There is an exodus of some people out of the area. I'm not seeing this exodus coming yet from companies, but we are seeing it from individuals. I've heard it from agents all over the place. At first it's anecdotal, but I know the surveys are beginning to show that people are moving to like Idaho, they're moving to Colorado, Utah, they're moving to Arizona, Texas, even Nevada. I follow this one guy on YouTube. He's got interesting different podcasts on a daily basis that he puts together, YouTube videos, and are pretty phenomenal videos. And basically, he's going to Vegas so that he doesn't pay any state income taxes. So that's one of the big reasons he's able to buy a big gigantic house here, a house there, and he has a very, very lucrative business. So if he's not paying income tax, he did the math, and he's going to be able to, it's like as if he's buying his home for free. He did the math over 30 years of what that looked like, and it's really the amount that he's saving is pretty astronomical by moving to Vegas, because he is of high net worth as well. But so there are a lot. We're not seeing all those surveys, but there will be more surveys and more stats that come. It's just so new, but it's definitely happening and it's occurring out there right now. Let's see, any other questions that we have? Do you have any numbers on investor purchases versus owner occupied and the trend over the time, say since beginning in 2019? Yeah, we don't have those numbers either yet. Those have to be done through surveys. But intuitively, you know that investors are having a harder time finding something when they're competing against so many different people. They really, the target market for anybody that's an investor or that is out there looking to purchase something, the best thing to do is to look for people that have been on the market for over 60 days. And you're saying there's nobody like that. There are. I've done that research. There's a number of people sitting on the market. It's like at least 25% of the market has been on the market for 60 days plus. There are a couple of counties that between 5 and 750, I think it's San Diego and Orange County specifically, that it's down to like 15% have been on the market for 60 days plus within the 5 to 750, which is the hottest range. Yet there's still 15%. So there's still people that have been on the market for 60 days. And those are the people that I would target, because those are the people that are more apt to be more realistic in their negotiations because they've been sitting for so long. So don't have all those stats yet either. A lot of that's done through surveys. Any other questions? Can't hear Stephen. What's going on?
That's what I already showed you.
Oh. Where do you see interest rates in 2021? I see them floating right now because I don't see the economy totally chugging and coming back online immediately like so many people are hoping and anticipating. So we're going to be anywhere from 2.75% all the way up to 3.25%. Of course, that's the range that I'm looking at. It could even go higher than that if the vaccine timeline is shrunk and the sectors of the economy that have been suffering for the longest start to come back online and we start to see some health. At that point, then we would start to see the 10-year treasury rise and we'd see mortgage rate rise as well. But even if we saw, what's the worst case scenario, I think we could see interest rates rise to 3.75%, which is a whole percent higher than where we are today, which is why you need to pull the trigger now if you're a buyer. Values are on the rise and we're at record low interest rates. So when do you get in? Now. You don't wait. Let's see. What do you see happening in the coming months for renters and homeowners behind in payments due to COVID-19 lockdown? I can only see the first half of your question. So what do I see with in the coming months for renters and homeowners behind in payments due to COVID-19? So the renters are going to have to work something out with their landlord or they will be risk getting evicted. And in California, they have to pay, like I said, 25% of everything that they've been behind by the time they get to January 31st. That's from August through January. They have to pay 25% of all that outstanding rent. So, and if they can't come up with that, the eviction process can ensue. So there will be evictions. And like I said, this, and I've been saying this for a while, that the biggest blow in the economy as far as the unemployed is it mostly affects renters. It does affect some homeowners, but the vast majority of them are renters because the biggest subset of unemployed and people on unemployment is the 18 to 24 year olds. 18 to 24 year olds. So that's pretty much renters, and they're the ones that are getting hit the hardest. So I anticipate that we're going to see a lot of evictions. Everything's going to be really busy. I know of people that even down the street from where I'm at here in South Orange County, a friend of mine just put new paint, new carpet. He had one tenant that left, and then he in turn had somebody that was so interested in the place they were willing to live in the place while they were continuing to paint and finish up, because and that just shows you there's still an appetite for renting as well. So I think this is going to fix itself probably better than what a lot of people are anticipating. There'll just be this big avalanche and a lot of negativity. But yes, it'll hurt, but it's something that we have to track. And right now, everybody's just surmising where they think things are going to go. So I'd rather look at the data and see how it all unfolds, because it's not really unfolded. When everybody worries about something, they tend to worry and come up with the worst case scenario, and it tends to not be as bad as what everybody makes it out to be. So let's see. Daughter moved to Nashville, and their DMV said California is half of all transactions. Okay, Nashville's another place where people are moving. Brent, I'm sorry that your daughter moved so far across the United States, but Nashville's pretty. Let's see. Can I have any of my agents see your previous Facebook broadcasts? Absolutely. They can look at my Facebook live broadcasts, and we actually host them on our website, reportsonhousing.com. That links up to our YouTube channel, which is also Reports on Housing. So you can look at it there as well. If there's no more questions, it's been about a half hour. I just want to say cheers to everybody. I hope everybody has a fantastic weekend. Enjoy your weekend. Enjoys it. My wife is now laughing at me. Enjoys your weekend. We'll see you on the other side. Have a beautiful weekend. And this is like fall weather, so pretty fantastic, huh, Alana Jo? Did you want to say hi to the people? I've got kids that want to say goodbye to everybody. So there it is. This is Lana Jo. She's rocking wet hair. How are you doing, Alana? Good. You ready for a good weekend?
Yeah.
Is that all we have to say?
Yeah.
That's it?
Yeah.
Oh my gosh. How about you? What's your name?
Mason.
You ready for a good weekend?
Yeah.
Good. So, you have anything to say to the people?
No.
Okay, get down over there. Okay, come here, Zeke. Hey, Zeke, say hi to the people. Say hi to the people. You can just hear him. You can't see him. He's very shy. He's very shy, like his mother and like Mia.
I'm good.
I'm good, she said. Cheers, everybody. Have a fantastic weekend. We'll see you on the other side. Enjoy this beautiful weather.